Let's dive into more detail about FHA loans. If you don't have a high credit score or don't have enough money saved for a 20% down payment, an FHA loan could put homeownership within reach. At a glance, FHA loans offer low down payments, low closing costs, and less stringent credit requirements. An FHA loan is a mortgage insured by the Federal Housing Administration, or called FHA, which is part of the U.S. Department of Housing and Urban Development. FHA loans are issued by an approved mortgage lender, like Union Home Mortgage, who are protected against loss if the borrower happens to default on their loan. FHA loans, popular with first-time homebuyers, were created to help more Americans with low to moderate incomes realize the dream of homeownership. Being eligible for an FHA loan is not dependent on specific income amounts, but you have to show a steady employment history. With an FHA loan, homebuyers can borrow up to a certain percentage of a home's value, which is dependent on their credit score. With a 580-plus credit score, you can borrow up to 96.5% of a home's value, which means the down payment is only 3.5%. And with a $500, $579 credit score, you may still qualify for an FHA loan with credit scores as low as $500 with a down payment of at least 10%. An FHA loan requires a credit score of 580 or higher for a down payment as low as 3.5%. Your credit score can be in the 500 to 579 range with a 10% down payment. Borrowers with credit scores below 500 will not meet minimum requirements. Debt-to-income ratio, or called DTI, is used to evaluate creditworthiness and might impact the down payment amount and the overall odds of approval. And finally, the property must undergo an appraisal to make sure it meets government standards for health and safety. An FHA appraisal is separate from a home inspection. There are a few more requirements to keep in mind, like the home has to be a primary residence and you must occupy the property within 60 days of closing. An FHA loan can be used to buy or refinance several types of homes, including single-family houses, condominium units, certain manufactured homes, mixed-use properties, provided at least 51% of the space is dedicated to the residents. Some types of FHA loans can also be used to finance new construction or renovate an existing home. All FHA loans also require you to pay mortgage insurance in the form of a mortgage insurance premium, or called MIP, regardless of the amount of the down payment. MIP is split into two components: an upfront premium and annual premiums. MIP is similar to private mortgage insurance, PMI, on a conventional mortgage. Both PMI and MIPs are a form of mortgage insurance that protects lenders in case the borrower defaults on the loan. Typically, you pay the MIP for the life of the loan, even once you reach 20% equity in your home. If you make a down payment of more than 10% on an FHA mortgage, MIP is paid for 11 years. It is possible to refinance an FHA mortgage to avoid paying a MIP, but this comes with its own set of financial considerations. Regardless of the type of FHA loan, there will be limits on the mortgage amount. The upper limit for FHA loans on single-family homes in low-cost counties is just over $524,000, while the upper limit for FHA loans in the highest-cost counties is just over $1,209,000. FHA loans can be extremely valuable to borrowers who may otherwise not qualify for conventional mortgage financing because of limited savings for a down payment or lower credit scores. The higher costs associated with buying a home with an FHA loan can be a welcome trade-off if you're interested in going from renting to beginning to build equity in a home. Contact us today or visit FHAHomes.com to find out more about how homeownership could be within reach and to apply for an FHA loan.